Hello, hello, hello.
Hello, hello. How are you?
I'm doing wonderful. How are you?
I'm doing really good. Happy New Year.
Oh, definitely. Happy New Year to you too. 2023 is going to be even more amazing than last year.
Yes, 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 absolutely. So let's take a few minutes to just introduce ourselves and tell us tell you guys where we're from and what we're going to be talking about today. So my name is Amanda Wilkins. I'm a mortgage banker with Norcom USA. My NMLS number is 1781437.
My name is Sabrina Betts. I'm a realtor in Connecticut, serving all of Connecticut, and I'm here and having a good time.
Absolutely. There you go. There you go.
Exactly.
So it's the new year. So we're in the new year. It's a good time for people to think about purchasing a home. People that's always have the dream of home ownership. Maybe last year you were not able to purchase for whatever reason, and you're saying this year is going to be your year. So we're just going to hop on here and just talk to you guys about the things that you need to do starting today, starting this month, starting right now to prepare you for home ownership. Because people can be ready to purchase, but are you prepared to purchase? So that's a big one, and that's something that I actually saw on your Facebook page, Sabrina. That was a nice quote. You can be ready to purchase, but are you prepared to purchase?
Exactly.
So
Because we
I
want
like
a
that.
lot of things, but we got to get ourselves ready. Be ready so you don't have to get ready.
Exactly.
That is what you have to do. And purchasing a home and purchasing property is a journey. It is a
Mm-hmm.
long game. It's not anything that, anybody who wanted to buy a house today, somebody closed on a house today somewhere, and they prepared themselves for that process. Because so it is a long process. So we want to prepare you guys. Any questions you have, that's what we're here for. But that's what we want to talk about is a couple of things to get you going, so we can get you on into that home or into
Exactly.
that, your next investment property.
Exactly. Okay, so the first thing we're going to talk about is reviewing your credit report. And Sabrina put on at the bottom of the screen where you can review your credit report at annualcreditreport.com. So, Sabrina, let me ask you, do you use Credit Karma, or what do you use like when you're reviewing your own credit?
No, I don't use Credit Karma.
Okay.
No, I don't use Credit Karma. I use Experience, the TransUnion, Equifax. Those are the ones that I go by. Those are the ones that you, as the mortgage loan officer, goes by. That
Hmm.
is what I want to look at. That's the information I'm looking at to see what is on my credit report, what needs to be rectified, if anything. Anything could be on it. Something could be on it that's just a mistake and is not me. But I always utilize that and get my free credit report each year. Why not? Number one is free, and number two, you don't know what you don't know. Items could be on there that you do not know about. And if you want to prepare yourself and be ready for home ownership at some point, and whether or not you want to be a homeowner, it's just a fact that you may want to purchase a vehicle or down the line purchase anything that requires running your credit. You don't want
Hmm.
something on there that doesn't even belong to you. It doesn't make any sense. Take the time to look for it.
Right.
Well,
Yep.
what do you look for, Amanda, as
Yep.
the loan officer?
I do not utilize Credit Karma or the Credit Sesames. I always tell borrowers to go through the three major credit bureaus them directly, like you said, Credit TransUnion, Equifax, or Experian. You can go through them directly and pull your credit, or you can visit annualcreditreport.com and you can get all three credit reports for free. Now, annualcreditreport.com does not provide the credit score. It only provides the credit report. And typically, that company will allow you to get one free credit report per year. But because of COVID, they are now allowing people to pull their credit for free every 7 days. So you might want to check to make sure that's still. I know during 2020 and 2021, and also 2022, they were allowing people to pull their credit every 7 days. I'm not sure if that changed for 2023. We're still in COVID, so I'm pretty sure it's still the same. But just check. It will tell you on the website once you visit the website whether you could check your report every 7 days. And just remember, when you check your report yourself, it does not hurt your credit. If someone else pulls your credit, that's when you're going to start looking at dings. So I always encourage people to check your own credit report because you're not harming yourself if you're pulling your own credit.
Okay. Wonderful. That's a good point. That's
Yeah.
definitely a good point. And also credit report, obviously, if you don't even want to, again, don't want to purchase, but if you are looking to rent, a lot of renters, a lot of companies asking for credit scores. So
Hmm.
that is huge. That is has been a huge stumbling blocks for a lot of people. So you want to make sure that your credit is in a good place. So
Right.
that's a good thing.
Property managers, landlords, they're looking at your rent history and see if you have any
Exactly.
evictions on there. So that's why it's also important to pull your credit report at least once per year to evaluate what's on there. And January is the time to do that. We're in a fresh year. You're starting over. So yeah, January is the best time to pull your credit and evaluate everything that's going on so that you can prepare yourself for either purchasing a home or trying to rent a home. And if you're looking to purchase a home, here's why you want to look at your credit report. You want to look at your credit utilization. So people don't realize the credit utilization is so important. That's one of the factors that's going to determine your credit score. So if you have too much credit card debt and you are, let's say if you have 5 credit cards and they all have a $1,000 limit, and let's say you are maxing out all 5 of those credit cards and you're only making the minimum amounts due each month, that's letting the credit bureaus know that you are utilizing too much credit. So they're going to look at it as if you have maybe a financial issue because you have too many credit cards and you're maxing them all out and you're only able to make the minimum payment per month. So the rule of thumb is to only use 30% of your credit limit. And that's for each card. So if you have one card that has a $500 limit, you only want to use 30% of that, which is $150. If you have another card that has a $1,000 limit, you only want to utilize 30% of that. That's what's going to keep your credit scores in line, keep your credit scores high, and it's going to show the credit lenders and creditors, if you're trying to buy a house or buy a car, it's going to show them that you're responsible with your credit. And you want to make sure that if you can, pay your credit card bill before that 30-day billing cycle.
Exactly. And also, another thing is when you have so many credit cards like that, and if you only making a minimum payment, you're it'll take you forever to pay it off. So it's always good to pay extra so you can pay off your bills as soon as you possibly can so your credit score will go up, especially if you use more than a 30% utilization. So you
Right.
want to get underneath that because you want to ensure that your credit report, your FICO score is of up to par. The better your FICO score, the better your interest rates can be.
Right,
That-
especially when rates are already high across the board. So just imagine what a credit card interest rate is going to be, how much interest they're charging you if you're maxing out your credit card and you're only making a minimum payment per month. Like it was,
Exactly.
the interest is high, so you don't want to. It's like you're making payments for nothing. So good point. You want to make sure that you're just spending and using wisely.
Exactly.
Yep,
That just makes sense.
it just makes sense. Yep.
Especially if you have a $30 payment a month and you miss the payment, but your late fee is $25. Come
Mm-hmm.
on, it just the math isn't math. And
The
so you
math isn't
have to make
mathing.
it,
Yep,
no, it's not. You have to
you're
make it
absolutely right.
you just throwing your money out the door,
You just
throwing it
throw
out.
your money out the door. Yep,
Yeah,
pretty much. That's exactly what you're doing. Throwing your money out the
after
door.
$500 or whatever it was, $500, $1,000 credit card, but you throwing your money out the door because you never catching up.
Right,
It has to make sense. So
right,
if you have to set yourself on automatic payments each month just to have it in there, that $30 payment, that $50 payment, let it get going there because now it's paid, you're caught up. you're active, you're caught up, you so that you will not be reported as long as you're caught up.
Right. Right.
Right. So
Yep.
the next thing we want to talk about is what we call a 3-2-1 buy down because of what's been going on and the interest rates have went up. I won't say they're astronomical. I think they're balancing out pre-COVID. But a lot of people are concerned about the interest rates, and some people still feel as though they do not want to purchase, and that's fine. But there are different strategies that people that loan officers can offer individuals. So could you talk to us, Amanda, about the 3-2-1 buy down?
Yep, yep. So we know again, yeah, like you said, interest rates are up, and we know what plays a factor in interest rates outside of the crazy environment that we're in. The credit scores, which is why we talked about the credit scores first, that plays a role in what type of interest rate you're going to have. Also, the economy, the rates are up. And then the value of the home, loan to value, things like that will play a role in what type of interest rate. The better, the more value in your home, the lower your rate will be. The term plays a role in the type of rate you will get. The shorter the term, the better the rate. So the rates are just high. That's just what it is. Even if you go to a shorter term, rates are still slightly higher than where they were at 2 years ago. So 2.5 years ago. So with the rates being high, people are now starting to get back into arms, and they're starting to get do the buy downs. So buy downs are not.
Back up. What's an arm?
Oh, okay. Let me tell you what an arm is. An arm is an adjustable rate mortgage. Yep,
Exactly.
an arm is an adjustable rate mortgage, and just so people know, adjustable rate mortgages is not a bad thing. There just wasn't as popular over the last 3 years because rates were really low. But arms are really arms are good. I would suggest people to consider an adjustable rate mortgage because you can go like a 5 year adjustable rate mortgage. So it'll be fixed for the first 5 years, and then it would either adjust every 6 months or it would adjust every year. So you can be in a 5-1 arm or a 5-6 arm, meaning 5 years fixed and then adjust every 6 months, or you could be in a 7-year arm, depending on which lender you go to. Different lenders have different options. You could do a 7-year arm, and then it adjusts every 6 months or every year, or then a 10-year arm, fixed for the first 10 years, and then it will adjust every 6 months or every year. So just speak with your lender to see what type of adjustable rate mortgages they might offer, especially in this environment, because by the time you do want to maybe get a better rate, you can always refinance once rates go down to get into a fixed rate mortgage, so you don't have to worry about, oh, what's going to happen after that 5-year period. It'll give you time to kind of like think about what your next plan is going to be before your rate actually adjusts. So, and that kind of leads to the topic of a 3-2-1 buy down, and that's good that you asked me what's the difference, what's the arm, because now we're in an environment where people can kind of ask the question, if I want to do an arm or should I do the buy down? So a 3-2-1 buy down or a 2-1 buy down, depending on which lender you go to, is kind of similar to an arm, but a little bit different. So the 3-2-1 buy down is you're pretty much buying down your rate for 3 years. And every year is going to increase. The rate's going to increase. As opposed to an arm, the arm, you're going to be like fixed for that first 5 years, and then it's going to adjust. And we don't know what the rate is going to adjust to after that 5 year. So with the 3-2-1 buy down, let's say the current interest rate right now is 6%. And you want to do a 3-2-1 buy down. So 6%, you want to buy it down 3 points. So that's 3 points for the first year. That's going to put you at a 3% rate. And then the second year, it's going to go up 1%. So that's the 2 buy down. So now you're going to be at a 4% the second year. And then the third year is going to go up again to a 5%. And then the fourth year, you're going to be back at your normal rate of a 6%. So every year, your interest rate is going to go up. So you're temporarily buying down that rate. And every year is going to go back up, which means that your payment is going to go up. And people do that because they're kind of like, I need another solution. The rates are too high. I need a temporary buy down because I'm going to get a promotion next year. By the time my rate go back up, I'll be making enough money to be able to afford that 6% interest rate. So that's kind of the idea of the buy down. But people, you have to be careful about it because with the arm, again, you kind of know 5 years is fixed, then will adjust every 6 months or every year. You could always refinance the arm. You can refinance a buy down as well, but you have to be careful with the buy down, the 321 or 2-1 buy down, because you also have to come to the table with closing costs, the difference of that money, because you're temporarily buying down the rate. You have to pay to buy down that rate, and that money has to sit in your escrow account. So that way, when your payment goes back up, you will have enough money in your escrow account to make those higher payments on top of the homeowner's insurance, on top of the PMI, if PMI is needed, on top of anything else that's included in the mortgage. So you got to make sure you got to come to the table with those additional funds. So that way your escrow account will not overdraw once the rate goes back up to that 6%.
Mm,
So it's
interesting.
tricky. It's tricky. I
Yeah, it's
probably just said a mouthful, but the 321 buy down, the 2-1 buy downs is really tricky. So whatever that savings is, so let's say 6% mortgage, you're buying it down 3 points for the first year. And let's say your average savings for that year, your monthly savings is, let's say you're saving about $600 per month. So over a 12-month period, you have to bring all of that money to close. The 600, whatever the principal and interest payment is going to be, the savings times what that principal and interest payment was at that 6% interest rate. You have to bring all of that money to close, and it's going to sit in your escrow account for 3 years. So when the payment goes up, then you will have that money in your escrow account to pay that higher payment
to
on
offset
top of
it.
to offset it. Yep. On top of the homeowner's insurance, on top of your taxes, you'll have that money in your account already. So you're looking at paying points, thousands of dollars in points, on top of your any additional fees that you have to pay, closing costs, down payments. You're looking at a lot of money that you're bringing to the table when you're trying to do a buy down versus doing an arm. So honestly, the buy downs is not my favorite, but for some people it works. I would probably say evaluate both to see which one might suit you better. To me, I would probably tell somebody to just do an arm because you're saving money if you do the arm versus trying to do a buy down.
Now, if they do the buy down, when it gets to the last year, when they made it back to the 6%, if the interest rate at that point is 5.5, don't they qualify for the 5.5 at that point?
No, because their contract says 6%. So
So
they're
they
going to be
still
at,
have to go to six
they
percent,
still going to have
even
to go to
though
six
the interest
percent.
rate isn't at 6%.
Yep, because they originally did their loan at 6%. However, and this is why it's important to check with the lender that you're working with when you're doing that buy now, because you want to ask questions. You want to
Yeah.
ask, let's say you were in year 2 and the interest rate just so happened to drop. Let's say interest rates go from 6% to maybe 4.5%. And you're like, hey, I want to let go of this buy down and just refinance and do the 4.5%. So you want to check with your lender to make sure that you can actually refinance while you're in
Okay.
the middle of that buy down period. Because
Okay.
some lenders might say, hey, you can't refinance, which actually, I don't know any lenders, just from my research, I don't know any lenders that's not allowing people to refinance, but
Okay.
I can't speak for all lenders. I know my company, we are allowing people to refinance if the rates do go down and they're doing a buy down. You can refinance at any time, but
It just
that's a
makes sense, but
yeah, it
you're
makes sense.
right.
So people got to do their due diligence and make sure they're asking those questions with their lender to make sure that they can actually refinance if the rates happen to drop while they're in the middle of that buy down period.
Okay. That's interesting. That's some
Hmm.
good information. That really is. It's a good. It's a. it's a strategy that someone
It's a
can
strategy.
utilize to get into a mortgage, but they do have to know the ins and out of it. You know, it's not
Right.
a regular mortgage, and it can in essence it can save you money. You have to put money up front in this particular situation. It can save you money in terms of your monthly mortgage payments. So if someone, that if for the next 3 years, if my mortgage could be $1,000 opposed to $1,500, that can save someone some money. But
Right.
again, they have to come in on the front end, and then you have to know the logistics about whether or not what you can do with it. If the interest rate is lower, you get to that 6 year, like you just mentioned, and it's not 6% anymore; it's 5.5. Can you refinance it to the 5.5? It makes sense that you could, but you want to be sure.
Right. And like I said, people, you got to be careful because you got to come to the closing table with that difference to put into escrow. So whatever the savings is for those years, you're going to be responsible for coming to closing with those savings. That's the point of the buy down. So you want to make sure you evaluate the buy down option versus the arm option, because the arm option is just the arm. You're not bringing nothing to the table outside of your regular fees, which is the closing costs and any down payment for first-time home buyers. If you're purchasing a home, whatever type of loan you have, the down payment that's required. So you really want to evaluate both scenarios to see which option is going to be better with you, because better for you and your family. So,
Okay,
yep,
perfect. So that segues into our next tip, talking about down payment and closing costs.
yes,
So, as a new homeowner or someone who has bought a house several times, so either way, there is down payment and there are closing costs when you purchase a home. And sometimes there's programs. We have CHAFA here in Connecticut, FHA, down payment assistance. Um, House Hartford. But sometimes not sometimes, depending on what you have, what type of loan you have, and what program you apply to, you may have to come to the table with your closing costs and or your down payment. So,
yep.
and talk about that and the fees. The closing costs is just a whole lot of fees.
Yeah, closing costs is the closing cost fees is something different. We can never
Right.
predict what the closing cost fees will be, but I always tell people when you're buying a home, you got to have money. I hear people say all the time, like, well, such and such bought a house with no money down. That's a lie. They had money because even if they got down payment assistance, even if the seller paid closing costs, they still had to pay for inspection fee. They still had to do earnest money. They still had to do an appraisal. So they had money to purchase the home. They didn't purchase a home with absolutely $0. It doesn't work that way. So just so people can understand, when you're getting down payment assistance, the way mortgage lenders do applications, we do your application, we put in a system, hey, this person is looking for down payment assistance from wherever state they're in, whether it's OFA here in Ohio, or you have another program called OFA in Oklahoma, whatever state you're in, their down payment assistance program, we put that information into the system. Fannie Mae and Freddie Mac, they want to know everything about you. They want to know how much money you actually have in your savings account or checking account. They want to know everything about you. So if you're telling me that, hey, I don't have any money, I have about $500 in my account, I'll put that down and then I'll run the information in the system. Fannie Mae might come back and say, okay, even though this person is getting down payment assistance, she or he still need to show that they have $5,000 in their account, because what if this down payment assistance fall through, or what if the seller decides not to pay closing costs? We still need to see about $5,000 in this person's account before we could approve this loan. So people don't understand that Fannie, it's out of our hands as the mortgage lender. We run this information through Fannie Mae and through Freddie Mac. We have to follow their guidelines unless it's a portfolio loan where the bank or the mortgage company is going to keep that loan on their books and they're going to take whatever eat whatever loss comes as a result of that buyer not having funds. So typically, mortgage companies do have portfolio loans. I can't talk about how other people do their portfolio loans, but typically we run our stuff through Fannie Mae and Freddie Mac, and we go by their guidelines. So if they say like, okay, you need $5,000 in addition to whatever you're getting in down payment assistance, we have to follow their guidelines. So what I can tell people is you have to save. Save as much money as you can. Even if you want to, you can use a portion of your 401k. I know that's probably not ideal, and I honestly don't suggest it because 401k is for retirement, but people, they do use it because they really want to buy a house. They do use it, but I would suggest people to just save and don't be afraid to hear no. Now is not your time to purchase a home because sometimes it's just not your time. Sometimes you just need to save as much as you can. Put yourself on a strict budget. Buying a home, that's the biggest purchase that you're going to make in your lifetime. So you really got to rearrange your priorities and stop doing something so you can compensate for something else. So if you're eating out a lot of fast food, stop eating so much fast food so you can save that money to put into your savings account so you can get one step closer to purchasing a home. So you got to cut out something to gain something else. You have to really, really budget. Put yourself on a budget so you can be prepared for home purchasing. Even though you think you might be ready to buy, sometimes you're just not prepared. Like you said.
It's true. Unfortunately, it's true. You don't want to hear about that. Also, I love the that mattress money phrase because we all know if you have money in it's not vetted in the system, not vetted at the bank, you
Mm-hmm.
cannot just come out and here's my 10 G's, here's my 20 G's, and it's a down payment. It has to be vetted. So
It has to be vetted.
yeah, and you can receive gifts that need to be, documented as well, but gifts can be received to help you purchase your home. So that's a good thing. So that's
Yes.
wonderful. So
And
now,
that's good that you said that.
what you
Before we
say?
go on, that's good that you said that. Mattress money. People, if you are buying a home and you have money under your mattress, get it into a savings or checking account right away because
Something.
we need 2 months worth of bank statements. So you want that money to be sitting in your account. You want it to season. So you want to put it in there for 30, let it sit for 30 days. And then you want to show an additional 2 months worth of bank statements. So it really needs to be in there for 60 days. So that way you can provide the underwriter with 2 months worth, with 90 days. So that way you can provide the underwriter with 2 months worth of bank statements, and that $10,000 won't be randomly showing in your account. So that money really has to sit and it has to be seasoned for at least 90 days. And with gifts, and this is something that people don't realize either. Mortgage, when somebody is gifting money to you, they write you a check to put into your account for $10,000. You know what we're going to do? The underwriters is going to go back to that person that wrote you that check, and we're going to ask for their bank statements because we want to see where that money came from. Because now we have to make sure that they didn't borrow the money to give to you, and now you're going to have to pay them that money back. So we need to see their transaction history as well to make sure they actually had that money in their account.
Good point.
So it's levels. It's levels to it. So you got to make sure if somebody gifting you some money, the underwriters, one thing I always tell people, underwriters, their job is not to work for the buyer. My job as a mortgage lender, as a mortgage banker, is to work for the buyer, to help them get that pre-approval. The underwriter, their job is to protect the bank, to protect the mortgage lender. So they're going to find any way to say, we can't give this person this loan because they're at risk. And if they can't find a risk, then they're going to give you the loan. So they're going to dig until they can't dig anymore. And then they'll give you the loan. Meanwhile, I'm over here fighting for you because I'm telling the underwriters, this person deserves this loan. They don't care what I'm saying because they work for the bank. They don't care about me.
And that's
Their job is
another
to protect
point.
the bank.
I'm glad you said that because another point it is very, very, very important that the client is upfront with their finances, upfront
Mm-hmm.
with anything that they may owe, upfront with all kinds of things. Because, like you said, the underwriters going through there and they poking holes. Their job is to poke holes in that loan, poke holes in everything that they can find, so they can say, "Oh, nope, we're not giving you this. You're not getting the proof of this loan." You want to make sure that there's nothing for them to find. You want to make sure that we went through everything. So the client needs to, oh, if you owe child support, you owe child support. We need to know about
Yes.
that. If
Have
you
that child support paper ready.
yeah,
Have those documents ready.
you get ready. You have to speak up. If you owe it, you owe it. It is out there. It is. Let's get on a payment plan. Let's start addressing it, things like that. Because if you don't, and you go through this whole process, you went out, found this house, you want the house, only to find out, no, you can't get it because you have this old bill that been outstanding and you didn't do anything up with it. So
You
you have
just
to
brought up
be
something
straight
so
up.
good. Being prepared.
It's
When you know that you're ready to
it's
buy
the
a
number
house,
one thing. It's just it
you just brought up such a good
is.
point.
It is. It's just the
Yeah.
number one thing.
When you know that you're at that point to where you say, "Hey, I want to buy a house," make sure you have all of your paperwork and ducks in a row. If you know that you have a garnishment on your paycheck for child support or for tax liens, you need to make sure you have those that child support paper. If you're paying alimony, you need to make sure you have that divorce decree. We have to see it. We have to see everything. So any
Everything.
type of liens that being garnished from your account, anything that's being garnished from your paycheck, make sure you have the documents to support that garnishment. We're going to ask for it. We're going to need to see it before an underwriter is going to approve that loan. So get all of your ducks in a row. Have your W-2s ready. If you're self-employed, have your tax returns ready. 2 years, business and personal, all pages and all schedules. Make sure you have it all prepared. Make sure you have your W-2s prepared, 2 years. Make sure you have your pay stubs. Make sure you have everything together, bank statements. We need it all. We're
And not
digging.
only that, we're in a time of electronic.
Electronic. Mm-hmm.
Exactly. So everything is done electronically. So you can have that information in a folder, in a file, and you can have that ready, because what's going to happen is you're going to have to upload it to a portal anyway.
Anyway,
So you
yep.
might as well have all that prepared for you. I mean, if you want to start and have it in a manila folder, that works. That's fine. You can scan it after that up into a file. However you have it, whatever filing system works for you, but you really do have to keep track of it. It's a lot of paperwork, so that's why I mentioned the electronic version, because it makes sense, and you don't have to worry about it. You can put it on a flash drive or put it in a USB drive or whatever. Put it on there, have it available. Put it on your laptop, however you want to do it. But you could definitely have this information ready and update it at all times. Your bank statements, you can just go into your bank account and have that updated. So it's a lot of things that you can do where you don't have to make it as stressful for yourself. You can do
Right.
it. You can do it.
Yep. Yep. What's
Alrighty.
next?
The next one is we're going to talk about homeowners insurance and home warranties. So now you have the home and you've closed on the home. Now you have to pay for your home. Well, you actually for homeowners insurance, I know for FHA, now you correct me if I'm wrong, Amanda, that an client has to come up with their 1 year homeowners insurance for the whole entire policy. So they have to pay that up front before they close. That's
That is
part of
correct.
the
That is
okay.
for FHA and that's for conventional. And you
Okay.
also gotta have a 3 month cushion as well. So 2 to 3 month cushion. So not only are you paying the premium in advance, you also need a cushion because things happen. We know things happen. When house prices skyrocketed and went up, your taxes are going to go up once the value of your home go up. So you're going to need a 2 to 3 month cushion for homeowners insurance and for taxes. And then of course you're going to, if you FHA, You're going to have that mortgage insurance premium. It's going to ask for, you're going to have the mortgage insurance premium. You're going to have to pay a upfront premium for that, as well as the monthly payments that's included with your regular monthly mortgage payment.
What about the oh, let's talk about the warranties. So the home warranties, I think, is very important because when you purchase the home, after you have your homeowner's insurance, but that don't always cover every single thing. So some people think it's kind of like when you buy your car, and then it's like, oh, you're gonna get bumper to bumper insurance. That bumper to bumper don't necessarily cover everything, every single thing in that vehicle, and it don't necessarily cover every single thing in your home. So like one time we had a flood in the basement. The water, the insurance covered everything in terms of removing the water, replacing the furniture, everything. But the pipe, that one little pipe, they refused it. That did not, they covered the incidental, the items that got destroyed. But the pipe that caused it to, the broken pipe, they didn't cover that.
Wow.
Exactly. It's things like that you have to think about. It's kind of like, again, the car insurance. You get your car, you think, you got it from bumper to bumper. You have to be sure. You have to know exactly what your insurance is covering. And do you have the annual insurance? Do they reach out to you and say, hey, let's review your insurance policy? You know why? Because when you bought it year 1 to year 3 and 5, things have changed. Not only that, the items in your home have changed. You probably bought different furniture or whatever, more stuff. You've accumulated more. If nothing else, you've accumulated more. That's just a given.
Right.
So you want to make sure, do your insurance cover it? Um, and renters, we talking about homeowners, but everybody's not a homeowner, or nor do they want to be. But if you are a renter, why not get your insurance for your apartment? You should, because if your items get destroyed or there's a fire, unfortunately it happens. Your renter's insurance can replace your items, can put you up into a hotel or some, alternate living space until you can find something. So insurance is key. And you
Yeah.
work so hard to get this. You did all the steps that we just talked about, worked all this time to get it, and you feel as though I don't want to buy the insurance because it's too much. It's
Right.
costing too much. I don't want to spend an extra $200 a year or whatever it may cost, but it's worth it.
Right. And actually, I'm glad you said that. For FHA, it's required that you have your homeowner's insurance premium, excuse
Yeah,
me, escrowed into your mortgage. That is the FHA rule.
that's a good rule to have.
So you got to have your homeowner's insurance escrowed in with your mortgage. You cannot opt out of paying your homeowner's insurance on your own with the FHA loan or with any government loan. So for VA, FHA, USDA, you're going to be paying your homeowner's insurance with your mortgage and with your taxes. Those government agencies do not allow you to opt out to pay homeowner's insurance and taxes on your own. However, for conventional, you can pay your homeowner's insurance and taxes on your own as long as your loan to value is 80% or lower. So if your loan to value is higher than 80% at the time of purchase, it can be 85%. Your homeowner's insurance and your taxes is going to be escrowed in with your mortgage for a conventional loan. So I know people sometimes, and here's another important thing as well. Sometimes people switch insurance companies, and sometimes the insurance company, the mortgage lender, don't know that a person may have switched insurance companies, and they find out that they say, oh, this person is no longer with State Farm. We don't have updated insurance information. We're going to put forced place insurance on your mortgage. So now, because the buyer, the homeowner, did not inform their lender that they have a new insurance company, because people shop around. Sometimes people, they want a lower premium. They say, hey, my homeowner's insurance is too high. Let me shop around with a different insurance company to make my premium a little bit lower. And what they forget to do is they forget to call their mortgage lender and let them know, hey, I switched insurance companies. So now the insurance company is canceled. The old insurance company is canceled. Let's say State Farm. The mortgage lender get that notification that you're no longer with State Farm. They're going to send you out a notice and say, hey, you're no longer with State Farm. We need update insurance information, or we're going to put on your account what is called forced place insurance. Forced place insurance is where the mortgage lender is going to pay insurance for you, but it's only to protect their investment. It's not going to protect anything that you have. So if the house burned down, it's only going to protect their investment.
It's for them.
Right. It's not going to protect your computer, all of your jewelry, your furs, your bed. It ain't going to protect nothing in your house. They only protecting their investment. And guess what? That forced place insurance is like 3 times as high as the regular insurance. So they're going to triple charge you because you ain't got homeowners insurance.
Oh, that is it. Yeah, they gonna make sure
they're gonna make sure they're protected.
Yes, they are. That's like okay, it's not on our list, but that's like the taxes. So if you fail to pay your taxes on your home, the county, I mean your mortgage lender will go and pay your taxes for you. They're gonna make sure that those taxes are paid, and they will pay the taxes for that home. But trust and believe, it will be adjusted into your mortgage.
It's going to be adjusted into your mortgage. You're absolutely right.
Because they will not have you lose that investment because you failed to pay taxes. Because taxes trump mortgage. If at the end of the day, if you fail to pay your taxes, the city where you live at can come along and take your property. And you still owe the mortgage company.
You still owe the mortgage company. So they're going to pay it for you. And that typically happens. That's good that you say that. That typically happens when somebody, like we said before, home prices went up, so your taxes might have increased. And that causes, oh, excuse me, I have to cough. Sorry about that. That causes your escrow account to overdraw because your taxes increase. And remember, with taxes, you got to have that cushion. You got to have that 3-month cushion. So if the taxes went up and it doesn't cover that 3-month cushion, like you said, the lender, they're going to still pay your taxes for you. But now, like a checking account, your escrow account overdraws.
Yeah.
So they're going to get their money back by increasing your payments, because now they got to put that 3-month cushion back into your accounts. So they're going to increase it high enough to where you can have that 3-month cushion again, and then they're going to get their money back from paying your taxes because you didn't have that money in your account. So now your mortgage payment, you're going to get that random email or that random letter in the mail saying your mortgage payment just went from $1,500 to $2,500 because your escrow account is short. And we just paid the taxes for you, so we need to get our money back.
We need to get our money back.
Mm-hmm.
So in essence, that's how your mortgage goes up.
That's how your mortgage goes up.
The actual mortgage, it's the taxes.
The taxes and homeowners insurance. The only thing that we control as the lender is the interest and the principal. That's the only thing we control. We don't control taxes. We don't control homeowners insurance.
So there you go.
Those are the 2 things that causes the mortgage to go up.
That was good.
Yeah.
That was good. So there you go.
There you go. Those are the top things for the new year. If you're looking to purchase a home in the new year, some things that you need to know so you can be prepared, not just ready to purchase, but be prepared to purchase.
Get ready so you don't have to get ready, or be ready so you don't have to get ready. That's what you do.
So you guys know I'm licensed in how many states? I'm licensed in Ohio, Texas, North Carolina, Florida, Tennessee. So if any of you that's on the live, if you're looking to purchase, Illinois as well, if you're on the live and you're looking to get pre-approved or refinance, your home, or if you have older family members that needs to do a reverse mortgage on their home, I can help them with that as well. So you can feel free to contact me.
And you soon to be licensed in Connecticut.
Soon to be licensed in Connecticut. You're
That's
right.
right.
Our corporate headquarters is in Connecticut, so
That's right.
I soon to be licensed in Connecticut.
That's right. That's
Yep.
right. And if you're looking for any Linden, listing your property, buying and selling, rentals, give me a call.
Sabrina's your girl in Connecticut.
That's
Absolutely.
right. But this was good, Amanda. I
This was
thank
good.
you. We gonna try to keep this going once a week, like we said, and bring out information. So we hope that we'll get some engagement and people have questions, and we can have a back and forth conversation.
Absolutely. So this was a great live. This was a great live. So yeah, until next time, I hope that whoever is watching, who's ever on, that got a chance to watch, that you learned something from the live. And if you have any questions, just please reach out to one of us. We look forward to working with you.
All right, now have a good one. Until next time.
Until next time. Bye.
Bye bye.